Hey everybody, welcome to tonight's presentation. We're going to get started. We're presenting the commons on Stella, a 199 unit apartment building in Tucson, Arizona. And this is being brought to you by Fortress Federation Investments, and we're partnering with Break of Day Capital. And we're excited to be partnering with Gary and his team. We'll get to that in a second. First, a disclaimer. We're presenting information that we've gathered through our due diligence. You're encouraged to do your own due diligence. This is not the official offering. That will occur within the investor documents, meaning the private placement memorandum and subscription agreement, and we will let you know how you can get access to that on the portal toward the end of the presentation. So quickly, first I want to introduce myself. I'm Rick Martin. I've been investing in real estate since 1997. All up and down the coast before getting into multifamily and founding Fortress Federation Investments. And we look for value-add opportunities in the Sunbelt states. Currently, we have actually over 1,800 units as a misprint, and I myself invest passively as well. I got over 2,400 units there. And I do a bunch of educational information on the website in case you haven't been there. I write a lot of articles and I do some videos. So you can go to fortressfederation.com for that. As mentioned, very excited to be partnering with Gary and his team from Break of Day Capital. Gary co-authored the book Best in Class, which focuses on asset management and how to get the most out of your building. So he's well equipped to be leading the operations on this deal, and we're really excited to be partnering with them. There's three fundamental things you want to look at. You want to look at first, they say the operating team when looking at a deal, and I think Gary and his team check that box, especially with their impressive track record. We'll go over that later in the deal where in the presentation, where they have had some successful exits and are doing quite well in the Tucson market. Speaking of the Tucson market, it will have the lowest vacancy of any U.S. market in 2022. You can see there it edges out Tampa and is quite a bit lower than the rest. And in terms of rent growth, it is head and shoulders above the competition. Those are the top 10 markets in terms of market rent growth in the nation. And Tucson is projected to lead the nation by quite a ways. After you look at the team and the market, you want to make sure you're looking at a good deal. And I'm going to let the operating team go over the details, but I think I just want to point out, I think for me, one of the most important metrics is the delta in between in-place rents and what comps are telling you rents should be at in terms of market rents or pro forma rents and where it can go. And you can see, for instance, I'll just take the one bedroom, one bath there, where it's $743 at in-place rents. And once we're done with the renovations, those are projected to be up to $1,250. So about a $500 delta, which is very significant. I think the average delta we find in other markets is about $150. So $500, there's quite a bit of upside on this deal, and that's why I'm very excited to be bringing it to you. Just quickly, word on interest rates. I've gone over this before. There's a lot of fear about what's going on with interest rates, but you can see a very clear up and down pattern. And I was telling an investor the other day, it's almost like an induced coma by the Fed, where they purposely, intentionally raise interest rates. You can see in each case, it precedes a recession. Those are the gray areas. And then there's a steep decline downward where they'll go back to quantitative easing, and interest rates will come back down. And Jerome Powell even says it himself. He says we need to get back to a place where inflation is down low again, which is why they're doing this, and then mortgage rates are low again. So he's telling us interest rates are going to come back down. And then quickly, just that graphic in the middle shows how short we are in supply. We're about 6 million units short on new home supply, and that's leading to downward pressure on vacancy. So vacancy's down, occupancy's way up, and that is leading to tremendous rent growth. And you couple that with the tremendous amount of money in the market, the tremendous amount of demand, which is the graphic there on the left that's been created since COVID. There's just a lot of pent-up demand, and the graphic on the right is showing how little supply there is. So heavy demand, very low supply, and that is putting upward pressure on pricing and keeping cap rates, fairly close. Although they've come down a little bit with, they've been dampened a bit with interest rates. Fundamentally, values are going to remain high. So with that, I'm going to hand it over to Gary and his team to go over the commons on Stella. So Gary, take it away, please.
All right. Well, welcome everyone. I'm Gary Lipsky, president of Break of Day Capital. And over the next 45 minutes or so, I'm going to show you why commons on Stella is a great opportunity for you and why you should invest alongside us. We have a tremendous response already in soft commits. And there's been a lot of pent-up demand because the last deal we did was a 506C. This is a 506B. So that means you need to have a prior existing relationship in order to invest with us and or have a referral. So this is the agenda. At the end, I'll do a Q&A. And if you have questions, put them in the Q&A, not the chat. So it's just easier to follow when we get to that. So like I said, I'm Gary Lipsky, president of Break of Day Capital. We have, when we close our latest deal, Mission Antigua, in about a week and a half, we'll have a 161 million assets under management. We've sold a couple of properties already. I am the co-founder of the Asset Management Summit, the Real Estate Asset Management Mastery Podcast, best-selling author of the book Best in Class, and I speak at other conferences on asset management. I just spoke at MFIN Con this past weekend in Charlotte regarding asset management, as well as the Intelligent Investors Conference they had out here in Manhattan Beach in January. And it takes a team to properly asset manage a deal. And I have a great team that I'm very thankful for to help with all of our assets to outperform our pro forma. So I owe everything to my team, and you'll see on the left, Richard is our latest to join our team. Scotia Group Management is the company that we love working with. We've done, this will be the fourth apartment building we'll be working with them on. And I started when I was buying properties in Tucson, walking comps and whatnot. The best properties were managed by Scotia, and particularly Shar, the regional manager. And we're lucky to have her on our team and manage our properties. And they've done a phenomenal job. And looking forward to working with them again on this one. Okay, our strengths. So strong local partners already put in place, like I mentioned, Scotia, a lot of the vendors we've used over and over again. We're very selective in the properties we choose to purchase. Since we've been operating in this market for many years, I know all the brokers. We often get first looks on deals, and on this deal, actually, I got this sent to me in October when it was off market, and the sellers didn't sell during that time. But I've had an 8-month lead time on looking at this property. I've seen it during the day, at night, in the morning, many times over the course of the 8 months. So we really had a head start, and really excited to have this under escrow. We are focused on the Arizona markets, Tucson and Phoenix, and this will be our 7th acquisition in Tucson. Like I said, we've got thousands of data points because of all the properties that we've underwritten over the years, all the comps that we've walked, and we track all of that information. So we're able to see that information when we're looking at new properties to buy. We own 5 properties within 10 miles that are performing above expectations. We had sold one previously. We have another one in escrow, and another one is on the market as well. And asset management is our secret sauce. I have over 30 years of management experience myself. All right, here's our portfolio and track record. Remember earlier I said past performance doesn't equal future performance, but we've had a really nice run. Midtown on Seneca was our first property in Tucson. We sold that last year at a 1.7x multiple to investors. And that means if you invested $100,000, when we sold, you got back the total accumulation was $170,000. Midtown on Seneca is in escrow to sell, and assuming that all goes smoothly, that'll be roughly about 3.5x to our investors in under 2 years. The property here on top right was a Phoenix property we sold last year. That was a 2x multiple. And these are some of our other properties. Indy and Tucson, that's actually on the market. We've gotten some good offers on that one. That'll be assuming we sell it, we'll get some really strong returns to our investors in about 19 months. Again, I always say, assuming everything closes, it's a volatile market right now. So until it closes, it's never closed. Our Youngtown project in Phoenix is moving along nicely. We are, it was garden office space that we bought, and we have framed out, done rough electric and plumbing in almost all the 40 units, and we'll be building 64 new units by demoing the front building and adding a new building in the front and the back. That project's moving on nicely. We bought it for 1.9. We haven't even finished the 44 units, and it was appraised at, I think, 7.4. Once that's done, it'll be appraised much higher. So, we're always seeking value. That's whether it's a newer product or an older product, we're always seeking value for our investors. Second row on the right icon, we're getting huge rent bumps. Most of the renters most of our residents are renewing, which I don't want them all to renew, because then we can't get in there and fix the apartments, but they really love what we've accomplished there. And it's really great to see. That's next on our plate for Icon Park on the lower left, where we took it over about 6 weeks ago, and the paint is, I think they're starting this week, I believe, and then we'll be doing the landscaping, and we're already getting some really nice rent bumps. And then Mission Antigua, our latest deal on the lower right-hand corner, that is a 506C. And like I said, we'll close in that probably end of next week. It's a $59 million acquisition. All right, so why do we invest in Tucson? So here's some facts. Top 10 hidden gem real estate markets from the National Association of Realtors. Top 10 cities best positioned to recover from coronavirus. A little outdated, but it did phenomenally well during COVID, and that's what I like to see. I want to be in a market that can take a punch, and we didn't just survive, but we thrived during that period. Outside Magazine, number 2 best places to live, and then number 8 cities with the largest growth in high-paying jobs. All right, this is a great slide. Tucson will have the lowest vacancy of any U.S. market in 2022, 1.9%. So that's huge. What that means is that we can increase the rents, tremendously when, we're talking supply and demand. So when there's no rents available, you can really push the rents. And we see that when Dylan and I are walking comps, we actually struggle walking comps because there's just not much to see. So, there is just tremendous lack of housing, particularly in Tucson and throughout the U.S. We're over 5 million housing units short, and it's only getting worse. We're not keeping up with demand. Population is growing. There's more and more people need to rent as interest rates rise. They can't afford houses, and they're not making. Whenever they build Class A, and what this is workforce housing Class C. They don't build more Class C. All right, so as you can see, look at this rent growth. Projected to lead the nation 14% over the next year. We actually underwrite it to 0 the first year because we have so much loss to lease. We'll capture that over time, but we would never underwrite with 14% rent growth in any year. But it's awesome to see. And when we underwrite a property, by the time we take over, the rent will be usually above what we projected because of this such a quick, rent growth. Now, and obviously that's not going to continue year after year after year. They do project a rent growth to be about over 36% over the next 5 years, and we underwrote it, I believe, under 20%. We're always going to lean towards the conservative side because nothing really goes perfectly. If it does, phenomenal, and we've been able to sell our some properties in less than 2 years at a tremendous return because of the market, and we've been riding the wave. I don't necessarily expect it to continue with that same velocity, but we still think there's tremendous opportunity here in Tucson and in multifamily generally. Employment now at 3.7%, 9,500 jobs will be added in 2022. Actually, I just read an article today. Let me pull that up. Lincoln Property is building 4 giant warehouses on 77 acres within 6 miles of Stella. So that was great to see. Just more and more job opportunities coming in, not only to Tucson, but very close to our property. Here's a breakdown of the different employees in the market, pretty diverse. You've got the university, Raytheon, the Air Force Base. You've got healthcare, and Geico, Amazon, Caterpillar, and more companies are moving in here, which is great to see. And in this map, you'll see comments here on the lower right-hand corner of the map. All right, so on this map, we've got just a little overview of jobs and retail and restaurants in the area. So very conveniently located for people to get to these places. All right, here's an overview. Hopefully you guys watched the 2-minute video that we did to really give you a good feeling of the property, because it's very spacious. It's over 19 acres. And I mean, to me, I don't know what 19 acres is, but when you look at the video, you gotta get a feel of how spacious this is. It's all single story, which is huge, massive courtyards. It's a very it's like owning a home there, because you've got a huge backyard. You've got some of the units have its own private parking, and you've got plenty of space to play and whatnot for your family. And we'll be adding more amenities, and I'll get into that later. So yeah, here you'll see the pool area. We'll be adding, so this top left, we'll be adding more picnic area, just jazzing it up. We'll be adding, you can see it in the background. There's an oldish playground. We'll be creating a new playground with that kind of blue awning over it for a sun shield. And we'll be adding to the left of this a dog park as well. But yeah, the lower left-hand corner, you could see the really spacious property, which is very, very unique. And most have gone to kind of a desert scape, but it is this particular property. You don't want to go to a desert scape with all that. That's one of the big selling points here. So these are pictures of the model. They really did a really nice job. So we would update the flooring. You see the hard countertop, new appliances. We'll put hardware on all the cabinet doors. Every unit you see here in the back right, there's a washer, and the dryer is is outside in the backyard in the shed. All right, so here's the backyard. Here's a dryer. Here's what we're gonna do also is change out this this white fencing. It's not a good look, and we'll be able to get a premium for. We're gonna do a corrugated metal look to it. Certainly not cheap, but we feel, and the property management company feel like we're gonna be able to get a real good premium for that. All right, so our business plan. We are going to change the name from Commons on Stella to Icon on Stella. Icon is a name that we've been using at a lot of our other properties, and it seems to be, a big hit with residents. So we'll change all the signing. On the exteriors, we'll update some of the landscaping, some rock, some other greenery. Just to, some areas need a little bit more jazzing up, and that's what we'll do. Add some lighting and change out the backyard fencing, which I mentioned. As far as the amenities, the dog park, upgrade the pool and barbecue area. We're gonna change where you enter the leasing office, and so we're gonna open up the front wall and the clubhouse and really make it a really much more welcome area when you come into there. So I can see, and we'll also be adding an outdoor gym. We don't have any interior space, so we have plenty of land. So we're going to be buying some equipment like pull-up bars and sit-up bars and other stuff to provide for our residents, and adding those little amenities, dog park, new playground, allows us to charge a premium for our rents. We're always trying to separate ourselves from the competition, and this allows us to get a premium because residents will want to live at the nicer property and unique property, and having single stories, having your own backyard, having these really nice amenities will allow us to really get a premium. And Dylan's going to talk about some of the rent comps later that are really fantastic. We're also going to improve the property management company. So the seller and the property management company that we're buying from is the same seller and property management company that we are selling another property for almost 3.5x return to our investors in under 2 years. So we like this combination, and we just feel that there's tons of meat on the bone for us to be had. Huge rent bumps on the classic units and on the renovated units. And on the interiors, like I said, upgrade the appliances, the cabinet hardware, new countertops, new flooring. Half the units do have a swamp cooler, and so we'll be changing it to the regular HVAC units and that'll be a huge upgrade. So is the address built in 1964, 199 units. Most of the units, walk-in closets, full washer, dryer, storage shed. Here's the floor plans. So you see they've got 1+1, 2+1, and 3+1, and I believe the 2s and 3s make up about 85% of the units, which is tremendous. So they get, a nicer rent bump, the bigger units. All right, and I'm going to pass it off to Dylan to talk about the unit mixes and the rent and sales comps.
All right, thank you, Gary. So for the unit mix, as Gary was briefly touching on earlier, we've got 1 bedroom, 1 bath, 2 bed, 1 bath, and some 3 bed, 1 bath. Primarily, as you can see, based on the number of units, we've got more of the 2x1s. Currently, the weighted average in-place rents are at $931, but we think rents could be $1,250 based on our research, due diligence, and discussing with the property management team. If we go to the next slide, I can start touching on the comps here. So based on this comp set, the occupancy for these particular comps, it's 98%. So, vacancy is really tight here. It's in general in Tucson, over 96%. And we've been seeing, like Gary said, it's very difficult to even find a vacant unit to be able to tour. We were able to get inside on most of these comps here. So you can see here we've got Copper Creek, San Simeon, Catalina Ridge, and Lakeside Casitas. So first, Copper Creek. This particular apartment complex, they've got a pool, playground, basketball court, gym during office hours. They don't have washer and dryers in units. And the finishes, they're either classic or partial upgrades. Some have some vinyl flooring, others have the old tile, and some still have the carpet, along with white appliances. These are going for $1,025 for the 1 beds. San Simeon, this complex, they've got a pool, a dog park, a couple of old charcoal grills. In the interiors, they're a mix of classic and upgrades. Some have new appliances with washer and dryers in the unit, and others do not. They also offer a small patio or balcony off the back side. And these rents here on the 1x1 are classic for Copper Creek and San Simeon, so $950 at San Simeon. And these other 2 comps, Catalina Ridge, Lakeside Casitas, these are 2 really good comps. Both are owned and managed by a large private equity firm, Bridge Investment Group, and they're known for being very aggressive with their renovations and pushing rents. So this is really good for our comp set and for our subject property. At Catalina Ridge, they've been doing a lot of renovations on the common areas, new playground, a new dog park, soccer field. They've got a pool, some covered parking, no washer and dryers in the unit. And also the units are really small here at Catalina Ridge. So you can see, they're charging over $2 a square foot for their renovated units. From a dollar perspective at $1,057, it can be attractive. But once you walk into one of the 1x1s at Commons on Stella, and you see 745 square feet with the backyard, you're definitely going to notice a difference when you're comparing the size. Lakeside Casitas, this one is a really good comp based on the single story standpoint. It's one of the only in the near distance from the property that's single story, and it offers that single family home like living. Again, Bridge Investment Group, they're the owner, and they're beginning renovations. They've been spraying new paint, updating, and adding amenities. They're going to enhance the pool, the gym. They're going to add a soccer field. It's also common to Commons on Stella with the trees. They've got a lot of big trees and some green area. So that's another selling point for them. The last few months, they have started renovating the interiors. They've got stainless steel appliances, granite counters, new fixtures, flooring, lighting. And their level of renovation that they're doing at Lakeside Casitas, it's going to be at a higher end than what we're going to do at Commons on Stella, and they're going to charge a premium for that. So you'll see, they're charging $1,375 compared to our $1,250 for renovated units. It's also important to note that our classics are going to be $1,087 on average for 1x1s. So that fits in nicely with some of the other classic comps that you see there. If we go to the 2x2s or the 2x1 comps, again, same comp set. You got Copper Creek, San Simeon, Catalina Ridge, Lakeside Casitas. San Simeon actually has some renovated units with their 2x1s, and those are going for $1,420. Lakeside Casitas, they're going to be leasing at $1,650. So our renovated units at the $1,400. It's going to be a very attractive price for prospective tenants, when we're comparing ourselves to the comp set. And then we'll go to the 3-bedroom. Again, same comps, but the rents, as you can see, $1,600 for our renovated, $1,450 for our classics. Copper Creek, they're at $1,530 for renovated. San Simeon's at $1,450 for classics, and Lakeside, again at the high premium, $1,875. We expect Catalina Ridge, Lakeside Casitas, that a lot of tenants are going to get priced out, especially as more of the renovations continue with Bridge Investment Group. And these tenants are going to be looking for more attractive alternatives, and Commons on Stella is going to be that perfect alternative for them to rent at. We've got great units, large size, square footage, and we offer that backyard, and the new updated fencing and amenities that we're going to be putting in is really going to help it stand out. We can go over to the sales comps here, and Lakeside Casitas also recently traded back at near the end of 2021. 310 units there at Lakeside Casitas, and it went for $210 a door, and it's about 2.5 miles away from Commons on Stella. So really close, great sales comp, higher, newer vintage in the 1980s. But again, that price per unit at $210, makes our $185 basis very attractive. The Altera apartments traded recently this year at $195 a door, 80s vintage. It did have some renovations as well. So, that's a good comp when you compare to Commons on Stella needing a lot of renovations. And then we've got Seneca Terrace. That one sold. This one's sold for $247 a unit, which is really high on the price end. This one was 6 miles away to the north, actually. We've got really large unit sizes. Everything on the floor plans are over 1,100 square feet. And, this one's just a high watermark here. So, again, we're looking at a very attractive basis at $185,000 a door. Gary, we'll turn it back to you.
Yeah. When this deal came out, the whisper was 43 to 45 million. That's what the broker was going for. And market obviously has shifted, and so we stuck to our guns and got this at a much lower basis. So we're really excited about that. Let's see here. So here's a capital stack. We're going to be raising a little over 15 million. We've talked to a number of different companies that may put in a large check, either for pref or LP. We also may do we have a couple people interested in doing a 1031 into the deal. So there's, we're going to lock that down over the next couple weeks. But that will reduce the amount that we have to raise. The debt is very low leverage, 63.5%. It's SOFR plus a 3.75% spread. It's a 3 + 1 + 1. And what we do to mitigate the risk of rising interest rates is we buy a rate cap, and what that does is it protects us from interest rates going very high. Because once it hits that rate cap, it's a hedge, it's insurance. So they will fund any overage, and the difference between where it is now until we hit that rate cap is it's built into our model. We put the SOFR curve into our model, so we're protected. We know interest rates are going to rise. Whether we believe it's going to stay there or not, I personally don't. But regardless, it's not about what I personally feel and the data I have gone out and gotten. We use the SOFR curve model and we put it in, so we're protected, you're protected. All right, so closing costs and renovations. We have a 1.5% acquisition fee. The financing fee goes to our lender and our loan broker, who finds us the best deal. Every deal is a little bit different. There's some lenders that are more aggressive at some parts of the year or some parts of the cycle, and that changes continuously. And so the loan broker's job is to find us the best loan possible. Money for legal, plenty of money for working capital. We've got the interest rate cap fee, and then we have third-party reports and tools that we need for the property, and then escrow. We escrow the first year tax and insurance as well. On the right, you'll see our renovation budget. We have over $2.4 million to do work on this property. We have a pretty sizable amount for the unit interiors, and that includes the conversion to the HVAC. We have $270,000 for amenities. That's the playground and the pool and the dog park. Money for signage, a plumbing reserve, a roof reserve. These are things. Things break. And so you want to have money to be able to fix these things. You don't want to be have to do a cash call. We've never done a cash call. You want to have plenty of money to pay for these things, and that's what these reserves are there for. We have contingency money. We want to be able to pivot if we need to and cover anything that gets thrown at us, so that, like I said earlier, that we can not only survive but thrive during rough times, because you don't know when COVID's going to hit a Texas freeze or whatnot. And so we want to protect you. We want to minimize your downside risk and maximize your upside potential. All right, here's our pro forma. And so remember, we showed you a slide with a little over 14% rent growth. Look at right here in this cell, 0 rent growth year 1. We have 4.5 year 2, 4.5 year 3, and then 4% and 4%. So much lower than what they predicted. I hope there's 14% rent growth in year 1. That would be fantastic. It'll be hard. It's hard to capture all of that in year 1, and that's why you need to capture it in the preceding years, because rents, leases come up somewhat evenly throughout the course of the year. And so if someone renews, let's say in August, their rent won't be nearly as high as someone that renews, let's say, next July. So it's, when you take over a property, doesn't happen overnight. There's that loss to lease, and you'll see that here in this row. We're burning off a tremendous loss to lease, and that takes time. We don't expect to dramatically increase revenue. It takes years to implement your business plan, but we will be as aggressive as we can be to do that as fast as we can. And we have Here you can see in Arizona compared to Texas, real estate taxes are relatively flat. There's a cap of 5%. Usually it's closer to 3%. We have it at 5%. A growth throughout the holding period, and insurance in Arizona is much more reasonable than some of the other states. The property management company gets a 3% fee for managing the property, and then we also pay for payroll. All right, so financial highlights. We have two classes here. If you invest, well, that should say actually 75,000 to almost 500,000. It's a 70-30 split with a 7% pref and 50-50 thereafter after 15% IRR. Class B, if you invest 500,000 or more, gets an 80-20 split. That's an 8% pref and a 50-50 after 15%. So they get a really nice bump for putting in a sizable check. It's a 2.12x multiple, equity multiple for Class A. For Class B, it is actually a 2.18 equity multiple. And for Class A, it's a 17% IRR and 22.4% AAR. And the difference between IRR and AAR is taking into account time value of money. That's why that IRR is less. For the Class B, that's a 17.5% IRR and a 23.5% AAR. In-place rents are about $300 below market. And this is the good one if you can take advantage of it, that 80% bonus depreciation. So if you invest 100,000, you will likely get about an $80,000 loss on your K1 that you can use against passive gains, or you can carry it forward. All right, so here are projected returns for investors. So it's a big lift. So we project there is not going to be cash flow year one, but it'll start kicking in year two. We pay out quarterly, and it'll increase on year 3 and 4 and 5. So we predict a hold time of about 3 to 5 years. We've sold every deal so far in under 2 years. I don't necessarily project that kind of velocity going forward. If we hit a 2x multiple in under 2 years, then we would strongly consider it. But safely to assume that it's going to be a 3 to 5 year hold. You can see a exit cap sensitivity analysis on the bottom here, based on we project a 4.75 exit cap, and for this market, we feel that is very reasonable based on the very, very low vacancy in this market and the tremendous rent growth in this market. All right, so bottom line, why we like this project. It's a great value add opportunity. Like I said, rents are very, very low. This is something that we've done many, many times before. This is right in our wheelhouse. Very, very low vacancy in the city of Tucson and this submarket. Tucson is ranked #1 in the nation for rental rate growth, which is fantastic. Job growth outpacing the national average. And like I said, we've been very, very successful in the Tucson market. Why invest with us, with Break of Day Capital? Excellent track record. We're focused on this market. We're not chasing deals all over the country. We're focused on Phoenix and Tucson, and really more so Tucson, just because we get a lot more value there. Tons of value to be created. We're gonna more than double the NOI. And that means, we're going to create, on our projections, over $20 million in value, and that's based on real numbers. That's not based on the property is going to go up out of thin air like housing. This is based on increasing the NOI and dividing it by the cap rate. We have a very strong asset management team. we have experience navigating through rough waters, and quite honestly, these can be rough times, and so we're experiencing that, and that's very important. That separates us from other operators that might not have gone through some tough times, and tremendous tax benefits on this deal. So minimum investment is $75,000. You can invest with cash, self-directed IRA, solo, 401k. Priority will be given to those that fill out the paperwork, and after approved, wire their funds in first. We will take up to 35 sophisticated investors, and the difference between a sophisticated and an accredited investor has over $1 million in net worth, not including their personal residence, or makes over $200,000 as a single person or $300,000 as a married couple. So we do have plenty of spaces for sophisticated investors. We've never hit our limit, which is fantastic. I know there's a lot of people have reached out to me because our last deal was a 506c and they couldn't invest in that deal. So they'll be investing in this deal. We also are, like I said, selling another property. So the bulk of my investors will be moving all of their money, or most of their money, if they want, into this deal. So we already have a lot committed so far. And the documents should be ready Wednesday afternoon. We'll send an email for those that are interested to let you know the documents are ready. This will be recorded and will be sent out by tomorrow with the deck that we're sharing. Money needs to be in by August 1st, but again, first come, first serve, and our closing date is targeted to be August 18th.
All right, so the next steps, ladies and gentlemen, you'll need to register on the Fortress Federation portal if this is your first time investing with us. If you invested with us before, you can log in. The portal URL is there on the screen. And once you click on that screen, it's going to take you to here. This is where you're going to come up with your name and password. You're going to log in. And once in, you want to focus on that banner on the left. And at the very top, it says Invest on the left. You want to click on that. And that's going to take you to this page here and show you the commons on Stella as the active offering. And then you want to click on that green button there on the right that says Invest. And once you do that, it's going to take you here, and you can see a timeline there where you do your due diligence, look over the documents. The next step is Invest. That's where you want to commit, basically soft reserve your amount that you want to invest in the deal. Then you'll move forward and you'll sign the documents, and that's when you officially subscribe to the deal. Once you're finished there, you'll see the funding instructions where you can wire your money and make the investment official. Oh, by the way, make sure that I confirm that I reviewed all documents and have the necessary information to make this investment box checked down there, or you won't see that the next button won't be active and you won't be able to move through the timeline. Now, if you have any questions, confused about anything, please reach out. My information is there on the screen. You can reach me at rick@fortressfederation.com or the phone number there on the screen. So that about wraps up the presentation, and now we're going to hand it back to Gary and his team and cover the question and answer session.
All right, we answered Joe's question. Great. Is the Stella the name of the street? Yes, Stella is the name of the street. And like I said, we're going to be changing the name from Commons on Stella to Icon on Stella. All right, Larry asks, rents are growing, but where's your data showing rent growth in Tucson is number one?
Yeah, I believe that one was the Marcus and Millichap report.
Okay. Yeah. And quite honestly, we've seen it ourselves at our own properties. And that's a projection, that rent growth. But we've seen tremendous rent growth at our properties, the ones that we've taken over. The comps that we've walked, you'll see they're just not keeping up with it. And that's the beauty of Tucson. A lot of the owners fall asleep at the wheel and are not keeping up with rent growth. And we're constantly pushing and tweaking with in our weekly phone calls with our property management company to keep pushing rents and monitoring where our occupancy is. And you'll see in the pro forma, we have, let me go back to that slide because that, I don't think I pointed that out and it was really important. You'll see here, we don't push physical occupancy above 94% the first years and then 95%. Our first year, our economic occupancy, and that means paying people 67%, which is really low. Hopefully, and a lot of that is that loss to lease, but we're very conservative in our rundown already. So Larry, hopefully I answered that. But if not, come back to me. I know that's not necessarily a perfect answer, but hopefully I answered that to your liking. Joseph, when you mentioned that it's the same seller and property management as Midtown and Seneca, are you suggesting that they optimize for full occupancy versus rent increases? Yes, and not only do they optimize for full occupancy versus rent increases, they just, they don't take care of their work orders. They're just not to the level that we would expect a property management company to perform at. And it just means, there's just a lot of opportunity for us. Miles asked, what is the condition of the AC units? So a lot of them are on the newer side because they've been doing that conversion, which is great. So we won't have a lot of them breaking down, and we'll be installing new ones over the next year. So in theory, we should have very few problems there, where typically when you buy a property, you need to have a significant reserve account for the AC units because they do break down. So Joseph asks, Phoenix real estate prices have been coming down, at least according to headlines. Any impact on Tucson? Yes, as a buyer and a seller, prices have been coming down. We've seen things soften about 10% of late, and we bought this property, we feel, at a 10% discount. We feel that it's not going to have that same velocity necessarily as it has been, but we expect prices to continue to grow based on how we drive NOI. And that's why we feel confident. We're not expecting appreciation to just automatically happen. We're going to force appreciation. All right, Nancy asks, regarding the bonus depreciation, is 80% based on a preliminary evaluation by a cost segregation company? Yes, that is correct. We have a preliminary evaluation, and they've been pretty spot on every single time that we've used them. Yes, I mentioned a 1031 group may come in. We will minimize their voting rights, but yes, it may be structured slightly different, and we'll let you know. Regarding your comps, since the property is more like a single family rental, have you compared the rent at Commons against SFRs? I think that the value would be living at Commons on Stella. Yes, the difference is instead of having your own house, let's say, you've got all the amenities. You don't have to mow the lawn. You don't have to fix anything for the most part. Pool and playground and gym equipment. So that's really important. But we haven't done really a deep dive on that. We've done most of the comps based on other apartment buildings because that's what we get asked the most, and that's what we're comparing it to. But yes, that's a good question. All right, what do you or the group foresee to feel about asset prices in the future? Many economists predict falling asset prices or home prices with rising interest rates. So will we be able to sell this for a premium in 5 years? Yes, Larry. I strongly feel that way because interest rates are not going to hold. They're going to continue to go up, and then they're going to come back down, which they always do. If you look at the chart over the last 50 years, 100 years, they've always come down. There's such strong demand for multifamily, and like I said, we're over 5 million housing units short. So I feel very strongly this is one of the best asset classes you can be investing in, and one of the best cities that you can be investing in. There's just a strong demand for housing, and they don't make workforce housing. They make A-class properties that the people at this property can't afford to live in. They can't afford to pay $3,000 for new housing. So this is a great opportunity. All right, what are the demographics for the 1 and 2 mile radius of the comments? Dylan, you want to speak to that?
Yeah, so demographics, median home value is anywhere from 230 to 250,000. Median income is low 40,000s for the income. Ownership versus renter, it's about 50-50, 46, 54 for owners versus renters. Crime within this, it's actually got a really good crime rating compared to some of the other sub-markets that we've seen. So, feeling good about this asset from a crime perspective as well. We've also got an elementary school just across the street, so that's attractive, easy access there. And then some stores and shopping also within a couple miles. So.
All right, Catherine asks, I'm new to learning about multifamily investing. Your comps show or pro forma shows financials up to year 5. What happens after then? Is the intention to sell the building? So typically, we're going to sell in year 3 to 5 based on performance. If we, we're going to constantly analyze where we stand to the market by talking to brokers and getting opinions of value from them. And so if we need to refi, we can do that and hold it for a longer period. We can sell beforehand. We're always monitoring and adjusting based on our performance and the market's performance, and keeping all of our options open to protect you as the investor. And like I said, to maximize the what you can make. All right, Michael asks, can you give a quick description of your target renter? Yeah, so that is, let's say the manager at a Walmart, or someone that works at a restaurant, or is in healthcare, or works at the Air Force Base. It's a really wide range, but it's it's not going to be your lawyer, your CEO. It's the person making anywhere from $30,000 to $50,000 a year. That's the kind of renter we'll be getting typically. What is the quality of the nearby schools? What percentage of tenants are families? Dylan, do you have some of that information?
Yeah, tough to give specifics on that. School quality, generally speaking, schools in Tucson just don't have the highest rating generally. Same with crime compared to national averages. So school quality, I'd say substandard there. The other part of the question, percentage of families. Again, I don't have a specific on families, but Yeah, tough to give a specific based on number of families, but as we were doing our due diligence report and going through each unit by unit, occasionally you'd see signs, right, of children, elderly, middle age. So we definitely saw a wide variety. So if I had to, pinpoint a percentage on families, I'd call it the 30 to 40% probably had children.
Yeah, and the schools in any city. I mean, here I live near LAUSD. They don't rate highly, unfortunately, and we're not renting to people making over 100,000 or more, where that's a greater concern, or they can send their kids to private school. So I wish they were better, but that's never hindered us at any of our other properties. Any other questions?
All right. Thank you again, everyone, for tuning in tonight. I hope you got a lot out of it. Again, if you have any questions, reach out to me, rick@fortressfederation.com. We can set up a call, or you can call me or shoot me a text there, the phone number on the screen. Thanks again, everyone. Have a good night.
Have a great night. Bye-bye.